Hi everyone, we are from Group 10. The company that we choose is Petronas Chemical Group. Before we go further into the presentation, I would like to introduce our teammates. Next slide. So we have 5 members in total. The first one is me, myself, Mariam Ashari Biskiti. We have Nurhani Amira, Muhammad Nasiha, Uksa, and last but not least is Aisha. Okay, so moving on to the first part. Next slide. Is part one, the fundamental analysis. Under fundamental analysis, we have economy analysis, industrial analysis, equity evaluation, and financial statement analysis. So the first part I will present is the economy analysis. So Petronas Chemical Group Berhad is basically a Southeast Asian largest integrated chemical company. So for my part, we're going to explore the key factor influencing the PCG's operation and success. So according to the first point that you guys can see on the slide right now, it is a commodity prices. So commodity prices does impact PCG's profitability. Fluctuation can significantly affect the revenue and the profit. Moreover, economic growth, population decrease, and also the government policies does influence BCG's product demand. Move on to the third factor, cost management is very crucial, such as expenses like feedstock, labor, energy, and transportation impact the profitability of BCG. Lastly, is BCG does invest in R&D to improve efficiency and reduce environmental of BCG. Moreover, in 2023, BCG may encounter challenges as Malaysia GDP growth slows and factors such as ongoing US-China trade war and the global economy downturn, and the drought impacting the agricultural sector could diminish the demand for PCG product and influence its exports. So I will pass this presentation to the next presenter.
Hi, thank you, Mashita. Hi, my name is Ruksan, and I'll be discussing the industry analysis of the petrochemical gas market. The first one is market analysis. So the petrochemical gas market has experienced significant global expansion driven by increasing demand from industries such as automobiles, construction, packaging, and textiles. This market is substantial and is expected to continue expanding in the coming years due to factors like economic growth, population expansion, urbanization, and technology improvement. Moving on to the competitive landscape, the petrochemical gas market is fiercely competitive with several significant global competitors. Some PCG's principal rivals include Dow Chemicals, BASF, ExxonMobil Chemicals, and LyondellBasell. Competition in this market revolves around variables such as product quality, price, innovation, customer relationship. To maintain a competitive edge, PCG must differentiate itself through its product offerings, technology, and operational effectiveness. Next slide. Now, as for the supply and demand dynamics, due to its affiliation of Petronas, PCG has access to abundant feedstock resources such as natural gas, crude oil, and naphtha. The availability and cost of this feedback significantly influence the company's production cost and profitability. The demand for petroleum product is driven by industries such as automotive, construction, consumer goods, and agriculture to meet client demands effectively. PCG must continuously monitor market demand trends and be agile in adjusting its production capacities as necessary. Next slide. Moving on to the environmental and regulatory effects. The petrochemical industry is facing increasing scrutiny regarding its environmental impact. Regulations related to emissions, waste management, and product safety have become more stringent in many regions. PCG must focus on sustainable practices, including energy efficiency, waste reduction, and exploring greener alternatives in its production processes. Adhering to regulatory requirements is crucial for PCG operation. The company must stay updated on evolving regulation and ensure compliance to avoid penalties and maintain a positive reputation.
Alright, so moving on to the equity valuation. So for equity valuation, we'll be looking at 2 points, which is on the ratio, valuation ratios, and also on CAPM model. So on the valuation model, valuation ratios, we want to predict or estimate whether the stock is doing good or not based on the value or overvalue. And on the CAPM, we're going to confirm what we have estimates, whether it's true or not. So moving on to the next slide, please. Alright, so the first one is on PE ratio. So basically, how we estimate is basically on the time horizon and also PE evaluation. So on the time horizon, we know that 2020 is the year of COVID-19, so we can possibly say that the sudden drop or the reduce for all stock price generation for all companies is due to the COVID-19 restrictions and everything. Hence, we can say that 2020 is sort of an outlier, and we can see that Petronas Chemicals is doing good, particularly 2021 to 2022 is increasing, and the estimates for 2023 is also increasing for PE ratio, which means that price per earning ratio is doing good. However, if you compare it to their peer evaluation, also outlining BASF and also Lotte Chemicals, because their stocks is their PE ratio is very highly fluctuating, which we cannot really compare to those. So if you compare PCG's PE ratio is actually at the median level, but if compared to the highest ratio, it's like something like BASF 10.3 or something higher, 60.1 from Sabic. It's very low. Petronas PE ratio is very low compared to Sabic in 2021 and also in 2022. But also in 2023 estimates. Hence, we can say that this might give us a clue that PE ratio and PCG for price stock is currently undervalued. Now moving on to the next slide, please. So for the next slide on PB ratio. So for the PB ratio, it's quite the same, but then we're going to look at pure time horizon only because it's clearer that way. So 1.5, 2.04, 1.76, and 1.27. So obviously it has increased slightly, which is very quite new because increase from pandemic year to the normal year, perhaps because the economy is only opening, but then it drops 2022 and 2023. So from here, we believe that because PB ratio indicates that the lower, then the price is deflating. So we believe that the above indicators show that the PCG stock might be undervalued, also because of peer evaluation. Now, next slide, please. On the PS ratio. All right, so on the PS ratio, basically on PS ratio, when compared, PS ratio. When compared, PCG's ratio seems to have similar performance to Formosa Plastic, but far lower than Sabic's. This is because, on the other hand, this is because maybe because of fluctuations or maybe because of economic difference. But then, on the other hand, when compared to others, PCG ratio is basically above average. So from here, it kind of contradicts from our PB ratio and PE ratio evaluation. So it is unclear on the PE evaluation to determine whether the PCG is undervalued or overvalued. However, since Sabic is the closest peer company in the industry where we can evaluate since it have the same economic condition and also the current how the company is dominating, we can compare PCG PS ratio is still very far behind, which might indicate an undervaluation. However, further confirmation shall be made from the CAPM model next. Right, so next slide, please. Okay, so from the CAPM model, all the calculations have been done in our Excel, but basically this graph should tell you all. So basically, what I can explain here is that 3.07 is the risk-free rate, and then the SML is the SML line, and we are currently Petronas Chemicals beta is 1.286, which is slightly higher than the normal, which from 1. So from the red line here, from the thick red line, we can see that the estimated PCG is only at 17.69, but the real return daily rate for estimated for 1 year is actually at 144.01. So the gap difference is very big, indicating a very high undervalued stock for PCG. So we can confirm that from the PB, PS and PE ratio that the stocks for PCG, Petronas Chemical, is very undervalued, which means that it's very cheap in the market. That's why we can see more and more people is buying their stocks because it's undervalued, but the performance is very good. And that will be all for valuation, equity valuation. Thank you.
All right, thank you, Akmal, for the presentation just now. So we're currently at the last point of part 1, which is the financial statement analysis. Okay, next slide. We will start with the company's profitable first. So we will see the gross profit margin first. Okay, so gross profit is actually a financial metric used to assess the company's profitability and efficiency in generating revenue from its core business. So according to the diagram that show right now, we can see that PCG's gross profit rate experienced an increase from 24.7% in 2020 to 37.6% in 2021. However, it declined to 35.8% in 2022. Next. Okay, now is the operating profit margin. Operating profit margin is a financial ratio that measures a company's profitability for each operation before considering two things, which is interest and also the taxes. So the operating margin or the OPM for the company show a fluctuation over the 3 years period. It increased from 15.3% in 2020 to 30.7% in 2021. However, the OPM declined again to 22.91 in 2022. Next. Okay, so for this part is a net profit margin. So net profit margin is the financial ratio that measures the profitability of a company after considering all expenses, including operating expenses, interest expenses, taxes, and non-operating costs. So the net profit margin does experience a notable improvement from 11.04% in 2020 to 31.8% in 2021. However, it decreased again or declined again to 16.3%, signaling a decrease in profitability compared to the previous year. That's it. Next. Okay.
Okay, thank you, Mashi. Now moving on to the return on assets, ROA. Okay, so ROA is a financial ratio that indicates how profitable a company is in relation to its total assets. So for 2020, the ROA is 4.02%, 2021 is 16.97%, and 2022 is 12.42%. Okay, so the ROA has increased from 2020 to 2021, indicating that the company is more efficient and productive at managing its balance sheet to generate profit. However, the ROA declined to 12.42% in 2022, indicating that the company might have made bad investments and is spending much more money than usual. Okay, next slide, please. The ROE. Okay, so ROE is a measure of a company's net income divided by its shareholders' equity. So for 2020, the ROE is 5.15%, and 2021, 22.05%, and for the year 2022, the ROE is 16.85%. Okay, so this indicates that the company is more efficient and productive at managing its balance sheet to generate profits from the year 2020 to 2021, as there was an increase. However, the ROE declined to 16.85% in 2022, indicating that the company is becoming less efficient and at creating profits and increasing shareholder value. Okay, next slide, please. Okay, now moving on to the liquidity ratio. Okay, so for the year 2020, the liquidity ratio is 5.09 to 1. And for year 2021, the current ratio is 4.33 to 1. And for year 2022, 2.46 to 1. So Petronas Capital Group has a high liquidity ratio, which means that they have more than enough cash to cover their debt. However, over the years 2020 to 2022, the liquidity has fallen significantly and the current liabilities have also increased greatly every year, which indicates that the company is using its cash reserve to cover up its debt over the 3-year period. So this financial progress can be worrying, as the company might run out of reserves to cover the ever increasing debt if the pattern continues. Next slide, please. Okay, now for the cash ratio. For year 2020, the cash ratio is 3.92 times, and for year 2021, the cash ratio is 3.31 times, and for year 2022, the cash ratio is 1.37 times. Okay, so from the year 2020 to 2022, the company cash to cover their liabilities decreased by 2.55 times over the years period, indicating that the company's cash on hand to pay off their short-term debt are decreasing. So the company is using up a lot of their reserves to cover up for their liabilities and debts, and this could worsen their financial state unless the company can recover in the following years. So it can be concluded that the company is using up a lot of money reserve to cover up for their liabilities and debts. And yeah, okay, moving on to the next slide. Now for the debt ratio. Okay, so for the total debt ratio, for year 2020 is 0.23, and for the year 2021 is 0.24, and for year 2022 is 0.28. So this means that from the year 2020 to 2022, there's increase of 0.05 ringgit of total debt ratio during the 3 years period, indicating that the company's financial risk is increasing. Okay, next, the debt to equity ratio. So for the year 2020, the DE ratio is 0.28 times, for year 2021 is 0.31 times, and for year 2022 is 0.4 times. So this means that the amount of debt that the company has for every ringgit of equity increased by 0.12 ringgit in a 3-year period, indicating that the value for every ringgit of equity decreases over the year as they have to cover up for their increasing amount of debt. So it can be concluded that the company is struggling with liabilities over the 3-year period, and their financial situation might not be the best, but judging from their controllable debt growth and sustaining liquidity, the company shall not face any critical financial problems provided that they are recovering well economically. Okay, now for the last part of the assignment, the technical analysis. Okay, so this is the charting and technical analysis graph for Petronas Chemicals Group throughout 2022. So as you can see, the line along the candlestick chart is the moving average line. The green line indicates the 50-day SMA, the blue line indicates the 100-day SMA, and the red line indicates the 200-day simple moving average. And then the purple graph below is the relative strength index. Okay, next slide. Okay, now the candlestick chart is highlighted in yellow, which is the Bollinger Band squeeze, and the histogram below is the moving average convergence divergence. Okay.
Okay, thank you, Aisha. Hi, my name is Norhani Amira, and I'll be explaining on the technical analysis graph that Aisha has shown. So, if you may or may not know, Petronas Chemicals Group, Berhad, PCG, is Malaysia's top integrated chemicals producer and one of the biggest in Southeast Asia with almost 3 decades of experience in the industry. Its share prices annually from January 1st to December 31st, 2022 are shown in the graph. So, an indication to buy is seen on the RSI chart, as you can see on the graph, when the price declines dramatically between July and August. RSI stands for Relative Strength Index. It is a technical indicator used in the analysis of financial markets. Next, the MACD indicator that you can see on the slide displays bullish confirmation because the MACD line is below the 0 line and crosses the signal line, while the MACD histogram is negative. MACD is short for moving average convergence or divergence, which is a trading indicator used in technical analysis of securities prices. In light of this, the Bollinger Band indicator recognizes a buy trend. Bollinger Bands are envelopes plotted at a standard deviation, level above and below a simple moving average of the price. The upper band was increasing and the lower band was pointing downward when the price broke out following a period of consolidation. So due to the Bollinger Band squeeze, the price will rise to a higher equilibrium level and continue to trend upward for some time. Overall, all the three indicators suggest purchasing Petronas Chemical Group shares now and selling it when the bearish trend changes. So that's all from me and our team. Thanks for listening and watching. Okay, dah. No, sorry, kotak. Apa namanya?